Well, good morning, everybody. Welcome to our university webinar. My name is Max Rosenthal, one of the advisors here at Everhart Advisors. Really excited to give today's presentation, and I'm going to share my screen here. And excuse me if you can hear this sound on my computer. Try to avoid that. Okay. So we're going to talk about stock investing today, which we've actually done in a number of our presentations. Most of the time it's pretty high level, and today we're getting a little bit more in the weeds, so I'm going to use some more technical terms. But basically, there's a lot of information out there, and what we're trying to do here at Everhart is give you, distill the information down to something that's just really practical and noteworthy to help you make great financial decisions. We want you guys to build wealth and do it well and reach your financial goals. And we don't want to show you things that just aren't useful. So that's the heart of all of our presentations. And today, again, I'm going to share quite a bit of information, but all of it is to help you just understand stock investing better and therefore make better decisions in your wealth building journey. We are always here to answer questions. I'll actually have a Q&A session at the end of this, so you can write those in the chat box. But you also can schedule with us, at your leisure. We'll share contact information at the end. Without further ado, I will jump right in. And the place I'd like to start is kind of fun, asking you, who are the three wealthiest people in the world? This is a question I've been asking people lately, really just to help them understand what a stock is. And the most common answers I get actually are pretty accurate. Most people say Elon Musk, which he is, as of last week, the wealthiest person in the globe. Mark Zuckerberg is number 2, Jeff Bezos number 3. And you can see their actual net worth here in order. And I like to ask people, why are they wealthy? What is the reason? How did they become wealthy? And the answers I get actually aren't very consistent. People get confused when I ask that question, and maybe it's just a bad question. But what I'm trying to lead to is that they own stock, right? They, in their case, founded their businesses, but they're, largely the majority shareholders at the businesses that they started. And these are some of the, biggest businesses on the globe. Now, if you survey the land and look at who the wealthiest people are, in your neighborhood or just around the globe, you're going to notice it's predominantly business owners. And the beauty of it is, whether or not you own a business yourself, you can participate in business ownership through stock investing. So that's what we're going to get into today. And the first thing I want to talk about is what makes a company valuable. And that's essentially what you're doing when you buy stock, is you're buying a piece of the company. And the answer to this is it's profit. So the logical conclusion is, if a company does not generate profit and people do not think it will generate profit in the future, then it's not worth anything. So when someone's evaluating a company, a simple way to determine its value is basically to take its profit and multiply it by an industry multiple. So I like to give the example of Everhart Advisors. Let's just say, all of you listening, you wanted to buy Everhart Advisors. And let's just say, hypothetically, we made $1 million in profit. Well, if you purchased us for $1 million, you would make that back literally 1 year later, assuming we keep our profits the same. And then every year thereafter, you just would be making a ton of money that all be profit on your end. So we would not just sell our business for $1 million. We would sell it for multiple years of profit ahead of time. And that's kind of how the industries work. And so in the finance world, people use the term PE multiple, which is really just the overall price, the total valuation of the company, divided by its earnings, or in other words, divided by its profit. And there's many variables that go into the multiple. And so just to list a few, the most obvious would be the macro economy. At the end of the day, every business is influenced by kind of the global economy and the state of things. Another variable that's big is, can the business survive recessions? Will it lose all of its income the second that there's bad times around the corner? Does it have a diversified customer base? We literally had a company that we work with just recently lose its biggest customer, and they actually unfortunately had to shut their doors down. So it's very risky to just have one customer or even just a few. The more you have, the more attractive your business valuation will be. And then not only is it a diversified customer base, but are they loyal? Do you have consistent sales, or is it really lumpy? And then lastly, is the leadership within the company stable? Are there good processes in place, good corporate culture? There are so many variables we could list, but this is just a few that I wanted to highlight. And so, take Everhart, for example. If we make $1 million in profit and we have all of these items checked that make a business really attractive, well, we'll trade for a higher multiple. Maybe we'll trade for 15 times our earnings. Now, if we don't have these variables checked, we don't have a good culture, we don't have diversified customers, maybe we only trade for 5 times earnings. Someone that's trying to buy us, they won't buy us for much more than that because of those things. So I wanted to make this more practical and just list a couple of examples. Tesla, Elon's company, trades at 200 times its previous 12 months earnings. Sometimes people do the PE ratio off its future earnings, which would be a lot lower than this. So what this is saying is, if you buy Tesla today and they don't increase their profits, they just make the same amount of profit each year, it would take 200 years to make your money back. And then you would make profit on top of that beyond that point. So clearly, the investment world is saying they're not going to just make the same profit they did this past 12 months. They're going to grow their profits. That's why people are willing to buy Tesla at its current price. Some other companies, Apple is trading around 33 times its previous 12 months of earnings. Meta or Facebook is 25. So all of these are, tech industries. I wanted to show some other companies and different industries to provide just better perspective. So JP Morgan, one of the biggest banks, in fact, I think the biggest bank in the globe, trades at only a 13 multiple. So that is, a bank, they're not as an attractive business model as, different tech companies. Delta Airlines only trades at 9 times its earnings. Ford Motor Company, 8.5. And then I took the Vanguard S&P 500 ETF. That, as of last week, traded at a 26 times earnings. So that's predominantly the 500 largest companies. And then the international market's at 16. So again, depending on where you look, companies' valuations will be smaller or bigger based off many, many variables. But that's an easy way to look at how the overall valuation of a company is dictated by investors. And so I wanted to give you a snapshot, and some of you have seen this slide before, of the S&P 500 over the last couple decades, going back to 1960. Basically, in 1960, there was $3 of profit or $3 of earnings for every share outstanding. And a decade later, it doubled. A decade later, it more than doubled. The 80s was a little bit less than a double. The 90s was a little bit more than a double, and so on and so forth. This chart's a little odd because we break it down year by year after 2020 rather than decades. And we really do that just because the last 5 years have been so chaotic, and there's just been a lot going on. And we wanted to highlight, look, businesses have not stopped working. Earnings have continued to go up. And that is the core to why stock valuations have gone up. When you look at something like the S&P 500 and you look at it over long time horizons, I think people at this point understand that the market has been successful. Why is that? It's because companies are earning more money. They are earning profit. If they didn't make profit, no one would buy them. And so we don't think businesses are going to stop trying to earn profit. We think they're only going to continue to grow over time at large. Now, each individual business is a different story, but at large, this story is likely to keep unfolding. And then I don't normally share this, but we're taking a deeper dive into stocks. So I wanted to highlight that PE multiple. So in 1960, as I mentioned, there was $3 of profit for every share outstanding in the S&P 500. Well, you'll see the actual price of the index down here at the bottom. So if there was $3 of profit and it was getting sold at $58 per share, essentially, that means its PE multiple was 19. So investors were buying the future profits at a 19 multiple. 1970, it decreased to 15 times. 1980, it was at a 9 multiple, and then 14, and kind of go down the, each year and list, just showing that at any given moment, investors are going to have a greater appetite or less of an appetite to buy the stock market, buy different stocks. So the worst example really is 2000. This was the dot-com bubble right before it kind of popped. The internet had just come out. People were really excited about the growth of stocks with the internet being involved. And so it was much more expensive to buy the market. It was trading at a 24 times multiple. People thought earnings were going to grow really fast. Well, that was a pretty humbling decade. You'll notice that from 2000 to 2010, the actual value of the index decreased. That's the only time it decreased in all of these data points. So that's really driven not because companies earned less, but it's because of the multiple. People were spooked by the financial crisis, so they were scared to buy stocks. And instead of a 24 times multiple, it was trading at a 15 times multiple. And that's why the overall valuation was lower, even though companies actually earned more, over that decade. And so that's just one story I wanted to highlight. And then another thing I wanted to highlight, if it's not too much information, is the annual rate of return since these points as of end of last year. So in 1960, if you bought in at 19 multiple, from that moment to today, it's annualized at 10.5% rate of return. 1970, it's been 10.9. If you bought in at 1980, it's annualized at 12.1 and 10.6. So 2000 was essentially the kind of the highest point of the market. Some of you might be looking at this 2020 data point, which is heavily skewed by the government shutting down our economy. The second they turned it back on, earnings came back to what they were in 2019 and even grew some. And so the PE ratio came back down to a more realistic term. So that's a weird situation here. But needless to say, what I want to highlight is that no matter when you bought in, whether it was at a high multiple at like 24 or a low multiple at 9, if you invested for the long term, it has been positive. Literally every time, if you've held that to end of last year and even really to today, it's been a positive investment. And so owning stocks for long periods of time has been wildly successful, whether you're getting in at a high multiple or a low multiple. So I just wanted to break down how companies are valued. And now I want to get into what a stock actually is, which I've already kind of mentioned it. It's literally just a piece of ownership in a company. So if a company is worth $100 and they issue out 100 shares of stock, then each share is worth $1. So if you have one share in this example, then you own 1% of the company, and you probably don't have anything to do with the company other than just providing the capital, providing the money. They're out there, trying to grow revenue and decrease their cost of goods and make profit. So it's beautiful. You just have to provide the capital and you get to participate in the ownership. Some stock examples. So I've already mentioned Tesla and Apple. I'm going to stick with them. They issue out, Tesla does, 3.2 billion shares of stock. And as of last week, they were trading at $338 per share, which means if you buy one share, you had to cough up 338 bucks, and you only own 3.2 billionth of the company. So practically nothing, but it's not nothing. You own a piece of the company. And so anywho, that 3.2 billion shares times their overall stock price leads to their total market valuation. Their total market cap is what that's called, is just over $1 trillion. Apple issues out for 14.9 billion shares. They traded as of last week at 211. I think that's gone down a little bit, closer to 200. But anywho, they're around a $3 trillion market cap. So one thing I wanted to note is that when you own stock, not only will your price of the share change with basically the future profits of the company and how it's valued, but they can distribute profit back to the shareholder. And that's what's called a dividend. So not all companies distribute dividend income. It's their choice how they allocate profit. So keeping with these examples, Tesla does not distribute any dividends, which you really wouldn't expect them to. They're trying to innovate and create new products. And so they take every bit of profit and basically reinvest it back into the business, which in essence helps the shareholders. Apple, on the other hand, kind of similarly, you wouldn't expect them to pay much of a dividend because they are also trying to innovate and create new products, but they're a little bit more mature, have pretty stable cash flow, and they are able to distribute some of their profits back to the shareholders in the form of a dividend. So they issue out their dividend yield is close to 0.5%. So if you bought one share of Apple, it's around $200. And if you held that over the course of the next year, they likely would pay out $1.04 in dividend income. Now that could change slightly, but if a company is issuing out dividends, they don't like to lower it. They traditionally like to increase it as time goes on. So hopefully that helps you understand the makeup of a stock. You have the principal value, and you potentially could get dividend income when you own a share of stock. And then you have the term the stock market. The stock market is the place where people buy and sell shares of companies, and there's multiple markets out there. And technically, they're called exchanges. So the most notable is the New York Stock Exchange. There's also the NASDAQ, but there's exchanges all over the globe. And these are well-regulated and a secure place to buy and sell your stock positions. There's actually 55,000 companies listed publicly all over the globe that you could purchase. Only 2,000 of them are on the New York Stock Exchange, and then just over 3,000 are on the NASDAQ. So that's about a tenth of the available companies that you could purchase are listed on at least the dominant American exchanges. And then how is a stock price determined? Again, I already mentioned it's driven by its profit. That's what gives a company value. But then that price you see on the market every day is influenced basically just like every other item we purchase in the world. There is supply and demand, and the more supply there is, if demand doesn't increase, the price will decrease. The more demand there is and the supply stays the same or drops, the price will increase as well, and vice versa. So I just want to highlight that the market basically takes all available information out there in the globe. People interpret that, and then they come to the market and say, based off of my evaluation of what this company is, I'll buy it at this price. Take Apple, for example. If I do my own analysis and I think it's worth $300 a share, and I see that it's trading at $200 a share, then I'm going to go on there and buy it right now because I think it'll climb up to 300. So that's what's happening when people buy and sell. It's just based off their own evaluation. And there's a lot of money that moves every day, just over 800 billion exchanged across the global markets daily in 2024. So there's a lot of information and a lot of money that ends up impacting that final price you see on the market. We are believers that the market is really efficient, which means the second new information comes out there, you're going to see that stock price move instantly. The price you see today is likely the most accurate price for that company. There obviously can be, weird scenarios out there, but the market's very effective. And next, now that you know how a company is, valued and what a stock actually is, I want to talk about the different risks and expected returns for owning stocks. And first, we're going to talk about risk, which the obvious thing is if you're investing in stocks, that entails some level of risk. What we like to highlight is that not investing in stocks also entails risk. So whether you are doing something with your money or not doing something with your money, there's risk on both sides of the table. Our definition of risk is simply not meeting your financial goal. Now, there's different definitions of risk. Some people define it as just the level of frequency in which your, investment can change. People call that volatility. So if the stock, really fluctuates every day, people identify that as more risky. That to me isn't really relevant to you. We want to identify clearly established financial goals and then make decisions that will help us get there in the most reliable way possible. And so if your financial goal is to build long-term wealth or to create an income stream to last, a normal retirement lifetime, say 3 decades, then investing in stocks likely makes sense. And so most of you listening are 401k participants or clients of the firm in which these are 2 of your goals. So that's why we're here to talk about this stuff. So when it comes to stocks, if you study all the alternatives out there, there really isn't anything that can compete. So this, if you've seen our presentations, you've probably seen this chart before. It's a page out of a book called Stocks for the Long Run by Jeremy Siegel. If you're really trying to learn more, I'd certainly recommend reading it. It's pretty academic, but this gives us 200 years of data. It's really hard to find data before 1926. And this is showing real rates of return, which means net of inflation. And again, when you look at alternatives to stocks, there really isn't anything out there that can compete. Bonds and treasury bills are something that people like to invest in, which that's just debt, right? You're giving money away and getting some money back with interest. That can't compete with companies that are out there producing things and innovating and meeting consumer demand. Gold or other precious metals or other commodities, really, they'll tend to keep pace with inflation. But again, they're not producing anything. They just are what they are. They're not going to change to meet consumer demand. And then lastly, just owning cash, whether it's the US dollar, other foreign currencies, that's pretty much a guaranteed way to lose value over time, net of inflation. So if you're the type that's just holding on to a ton of cash, to us, that actually is risky. As time marches on, you're losing value. And we think if you own stocks, companies across the board are always trying to grow and innovate. And yes, it can fluctuate in the short term, but over the long term, it has been rock solid. And so let's just look at total stock market data on not a 200-year window. I know none of you are looking to invest that long. This is a great chart, and we've showed this in many presentations because it's so valuable. Basically, a total stock market fund over since 1945, in any calendar year, the best year was positive 50%. The worst was negative almost 40%. And we've seen everything in between. So if you were to say, hey, Max, I'm going to invest to buy a new car in a year, what should I do with my money? I would not tell you to get in the stock market. Way too risky. You could lose practically half your account. Now, when we look at a 3-year window, the odds are stacking more in your favor, less of a chance to have a negative outcome and still a very strong chance to have a positive outcome. It's really a decade and beyond. So in this, whatever that is, 80-year history almost, there's only 2 10-year windows where the market was down. Every year, every decade and beyond was positive. Every 11-year period has been positive. And the longer you go, it all tends to average around that 10% annualized rate. So for long-term investors, think about people that have 15 years from retirement, or even they're about to retire right now, right? They still have decades in front of them that they're planning for. stocks likely should be a part of a retiree's portfolio. So just really strong data here. And then I want to kind of close on this section with a little pop quiz. So since 1960, the consumer price index has increased 11 times, which means, things have gotten 11 times more expensive from 1960 to the end of 2024. That index is sort of the measurement of inflation, and it went from 29 to 315. Well, if you just own the S&P 500 and you were relying on the dividend income stream for your spending habits, it went up, and I'd love to ask all of you what you thought it went up. It went up 38 times. So just the dividend part, just the income that companies are kicking out went up 38 times, well past inflation. And then the principal value of these businesses, do you think they grew at the pace of inflation or more? And obviously the answer is more. It grew at 100 times compared to 11. So the longer the time horizon we evaluate, businesses historically have basically always beat inflation over the long term. So when you're evaluating where to place your money, we think owning stocks is a fantastic place to build real wealth. And then on the stock side of things, we are not advocates for stock picking, where you just buy one or two or three companies and even, try to guess which one's going to pop next. That's really a recipe for disaster, and I'll share that more. You've probably heard us talk about diversification. You've probably heard that term a lot. Just means you own many different businesses. And I want to highlight the different categories that you'll see when you're exploring different stocks and different mutual funds and ETFs. So there's what's called small cap companies, which really just means their total valuation, which is the amount of shares outstanding multiplied by the share price. That gives it its total market cap. So if it's below 2 billion, then it's considered a small cap company. If it's between 2 billion and 10 billion, then it's mid cap. If it's over 10 billion, then it'd be considered a large company. There's also this term called growth. So like if you look at your 401k, you might see a small cap growth fund or a large cap growth fund. And if it's a growth style company, that really just means that specific company is expected to grow faster than the overall market, which means when investors are looking at it, again, if they're going to value it based off its future profitability and everyone's expecting them to get more profit in the future, well, they're going to pay a higher price for that. And so growth-oriented companies usually have that higher PE multiple. They're essentially more expensive to buy because people are expecting them to grow more. Then there's what's called value companies, which essentially just means they're discounted relative to their intrinsic value. This is where you see a lot of dividend-paying companies. Companies that pay dividends usually are more mature. They have a very well-established product line and cash flow to where they feel like they can comfortably pay their shareholders back part of their profits. And they're usually discounted. And so from the PE multiple standpoint, people don't think their profits are going to grow all that much, so they buy the earnings at a lower rate, a lower PE multiple. And then there's also blend funds, which basically just blends the two, growth and value, inside of it, about 50-50 split. Next, I want to talk about, in light of diversification, how many companies should you actually own? So I'll talk about mutual funds and ETFs, which is a really good way to own multiple businesses. But if you're the type that wants to own individual stocks, there's been lots of data out there to kind of study what's the optimal amount. And a famous study that most investors report back to says you should at least buy 10 different companies. What happens is if you just own one company, you are subject to all the risks that are underlying to that company. The CEO could get caught in scandal, and the reputational harm to that business just totally brings it down. It could get caught in, being over levered in real estate, like Lehman Brothers did in 2008 when it totally went to zero. There's all sorts of company specific risks we could talk about, but if you own at least 10 of them, you've really mitigated the threat of all of them going down to zero. Occasionally, a couple of them might, but at least 10 is where we want to see people. Ideally, 30 plus stocks pretty much gets you out of the company specific risk, and all you're left with is market risk. You can never avoid the global market risk. And ideally, we want to see even more than just 30. The more you have, the more reliable your expected outcome is going to be. And so that's where mutual funds and ETFs come into place. Basically, it's a really cost efficient way to buy multiple companies. So take Apple, for example. If you only had $100 to invest, you literally couldn't buy a share of Apple right now. So because they're trading at around 200 or just over $200 a share. So what you could do is you could buy a mutual fund or an ETF, which just stands for exchange traded fund. You can buy a fraction of a share, and then that divvies out your money across all these different businesses. So one mutual fund might divvy out your money, maybe 5% in Apple, 4% in Amazon, 3% in McDonald's, and so on and so forth. So there's all sorts of different mutual funds and ETFs ranging from large growth to small value and everything in between. And I just want to highlight there are more funds than just the S&P 500 index. We often teach using the S&P 500 index data because it's a good proxy for the overall market. It's been a wonderful investment for a lot of people, but there are more businesses out there than just those 500 companies. And so I just wanted to highlight two other notable indexes, the Russell 3000 and then the MSCI All Country World Index. They're not just 500 companies, and they have a lot of reputable names inside of them: Spotify, DoorDash, Coinbase, Toyota, Samsung, Nestle, Shell, right? There's lots of companies than just those S&P 500. So we would encourage you to look beyond the S&P 500. And I think this is a really interesting data point. The last 15 years, if you look at that MSCI All Country World Index, it averaged 10% annually. Now, if you missed just the top 10 contributors each year, your rate of return cuts by about a third. And if you missed the top 25 contributors each year, it cuts down to 5.4%. Now, let me remind you, that index is made up of almost 9,000 companies. And I'm just talking about missing the top 10 each year. So those top performers really bring the market up. And it's just so risky to not participate in those guys. So if you're the type that you're going to go out and buy just a handful of companies, I would argue that is a lot of risk, in my opinion, unnecessary risk. You could just buy these great indexes and get these notable rates of return that have been tracked for a long rate of return, long time. That's a pretty reliable way to build wealth, in our opinion. And so I want to close on the diversification section with this chart, which is pretty chaotic, but what it's showing you is the highest return to the lowest return for each country across the globe. So you can see in 2005, Canada was the highest producer. The companies inside the Canadian market grew at 28%. The United States only grew at 5%. And you go down the list, it's impossible to predict what country is going to produce the best rate of return next year. So, the United States has done phenomenally over its existence, and especially over the last 15 years. But it's not like they've been the best performer every single year of the last 15 years. Here they are in 2024, the second best. 2023, they were fourth. 2022, they were towards the bottom. And so again, our encouragement is to not just own the S&P 500 index, which is United States companies. We'd love to see people own, different pockets of the globe and rebalance if possible. But just wanted to show you the benefits of diversification. Next, I want to talk about active versus passive mutual funds and ETFs. This is a term, you know, if you've looked at your 401k investment lineup or if you've studied stocks, you're going to see these types of funds. And so an active fund is simply a group that is actively picking different stocks to buy. So they'll usually track a certain category, say, for example, the large cap category. And they're looking at all the large companies and doing a lot of evaluation and due diligence, saying, okay, we think picking Apple, Amazon, and Google will generate a higher return than owning the entire large market at whole. And you have to pay people to do that. You have to pay people to do the due diligence and make those trades and pick the allocation. Passive investing is just tracking an index. Say, for example, the S&P 500 index. You don't have to pay a lot of money to own that because, yes, there's some work involved, but not a ton of work. It's just people basically making sure the fund is buying the 500 companies. And so there's some work involved, but they're not going to the companies and doing due diligence and evaluating if we should overweight or underweight them. So the average fund for average price for an active mutual fund is around 0.68%. So basically just over 0.5%. The average mutual fund price for a passive fund is less than 0.1%. So very, very, very cheap. So if you're going to buy active funds, not only do they need to beat the market, which in my opinion is very challenging, they have to beat the market in excess of the cost for it to actually add value to you. So we have this chart that we've tracked for a long time, produced by Spiva. They do it biannually, and they look at all of the active mutual funds in the different categories. So say, for example, large cap space, that compared to the S&P 500 index over the last year, and this was as of 12/31, so basically the calendar year 2024, less than half of those active money managers beat the index. So the index was beating more than half. And the only space to have a winner was the small cap, or I guess to have a net winner. Most of the active money managers in the small cap space beat the index, about 70% of them. Now, when you look at longer time periods, and I highlighted the longest period, 20 years, almost none of the active funds can really beat the index. About 10% of them can. And it's amazing. Again, we've been tracking this for a long time, looking at the report that's published every 6 months. And the data is wild. The 20-year marker comes out to be about 90% on almost every category, every single time. It's just really, really challenging for groups to beat the market, especially net of the cost that they charge. So I'm not saying that no one can do it. For example, you may have heard of Warren Buffett, one of the most famous investors, right? He has a wonderful track record of beating the market, but it's not for everybody. He's very talented. For most people, like you and me, just owning, pockets of large groups of funds is a great way to build wealth rather than trying to pick what you think will do best. It's just the data doesn't support that style unless you're a Warren Buffett who is just really talented and does it full time and has a great long track record and process. I'll close with this on the active versus passive segment. This is amazing. So for 2024, the S&P 500 index grew at a 23.3% rate. That is historically much higher than the average, which the average has been 12.3%. So the annualized rate of return is closer to 10, but this is just the average rate. Now we looked at, or this data by Dimensional looked at all of the equity analysts at pretty much the biggest institutions in the globe: Oppenheimer, Goldman Sachs, Deutsche Bank, Citigroup, Bank of America, Barclays, JP Morgan, Morgan Stanley. All of their equity analysts projected a lower rate of return for the S&P 500. And these guys have crazy amount of resources and very talented people there looking at charts and data points, and not one of them got it right. So anyone that tells you that they know what's going to happen in the future, hopefully you're not buying it. It's just really hard to predict. I really wouldn't bet on someone's random projection for the short term. And then I want to close with just the mental framework of owning stocks and owning businesses. This is arguably the most important part. Common objections I get to stock ownership is that it's just too volatile. I can't handle the swings in the market. I can't handle, in quotes, losing money, which you only lose if you sell after a drop, if you hold it long enough. Again, I just showed the data, and you're diversified. It has not been a losing game. It's been a winning game. Other things I've been hearing as of late is just, different elections, specifically in America, the last two elections that went down for president. I heard that line on both sides of the aisle. And then another one I've heard as of late is the market's too high. It's reached a high point, I'll kind of wait until the next drop. So when people say these things, that means that they're either pulling their money out or they're waiting to invest their cash until the right time. And I just don't think that's a good process, and the data supports it. So regarding volatility, this is the S&P 500 for the last 35 years. If you look at it in total, it grew at a 10.6 annualized rate of return. So $1,000 would have grown to 34,000. If you just missed the one best day, that significantly reduced your return. If you miss the 5 best days and even longer, that really chews into your day, into your overall return. So in a 35-year window, if you miss just the 25 best days of the market, I mean, it cuts your return almost in half. You're losing a ton of money sitting on the sidelines. And if you look at the actual data for when these best days happen, they're usually in the most chaotic moments right after a big drop. It's impossible to predict when it's going to happen, but it's usually in those volatile moments. And you compare that to sitting on the sidelines, owning even treasury bills, which gets you some rate of return. Your long-term wealth building is just going to really diminish. So we would not recommend it. And then I wanted to show this chart, which a lot of you have seen. These are the big drops, the ones that people are most afraid of. And we looked at how many months it took to hit the bottom point and then how long it took to recover. So in 1957, it took 3 months to drop 20% and then 8 months to recover. You go down the list, and most recently, you guys will have remembered COVID. It took 22 days, I think, to drop 34%, and then 5 months later, it was back. So that was very quick. More slow and more painful was the year 2022. It took 10 months down. 15 months later, it was back. On the average, it takes 10 months down, and 13 months later, it's back to where it was. So that's a total of 2 years. In my opinion, if you're a stock investor, you should be looking at a 10-year plus time horizon. So a cycle of 2 years of it going down and back shouldn't really impact you. Again, our investment philosophy is to ensure that you reach your financial goals. So the risk of not reaching your financial goals is what we care about. The drops along the way, as long as you have planned and have the time ahead, it shouldn't matter too much. So I just think knowing this data is really useful in your stock investing journey. And then regarding elections, these are rates of return for the different elections going back to Hoover in the Great Depression, from the start of their presidency to the end of it. So basically 4 years or 8-year cycles. The average rate of return was 9.5, which falls right into line with the 10% historical average of the market. Again, these are pretty short time horizons. So I guess not all of them are positive, but more times than not it is. And the big outliers, Herbert Hoover, President Hoover started his presidency basically at the peak of the Great Depression, which is not his fault. It wasn't the politics that led to the stock market crash. I could educate you on the history of that event, but politics gets people's eye off the ball, right? If you get wrapped up on what the political realm is doing, yes, they can impact companies, but at the end of the day, a business's valuation comes from its profit. And regardless of who's in office and what legislation changes they make, Apple is going to continue to try to make the best product they can at the lowest price for the consumer and at the most profitable rate they can for the company. And so, anywho, I just get pretty passionate. You're not investing in governments, you're investing in businesses, and the track record of staying invested through all the different aisles of the political spectrum has been wildly successful. If you look at 10-year data and beyond, almost all of them actually doubled from when they started. The market doubled. Only 2 of them didn't, and all of them were positive. So it's just amazing data for the long term. Lastly, I'll close on people getting scared after the markets hit a fresh high point. So going back 100 years, if you took the average rate of return from the new high point to 1 year later, it's actually pretty high. Once the market starts climbing, there's a little bit of a momentum effect to it. It can start to slow down, but it all tends to average around its long-term projection. These are just average rates of return. So obviously that means there's some cases that were below and some cases higher. But just because the market's reached a new high point, the evidence does not say that you should pull your money out. The evidence says you should arguably stay invested and keep going. So those are just answers to some objections we hear. There's a lot of other objections I could address. I want to close with some lines from investment experts. And these are the goats of the investment world. We'll start with Benjamin Graham, who is the author of The Intelligent Investor. He's pretty famous for basically being Warren Buffett's teacher. His quote is, "The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave. The best way to measure your investment success is not whether you're beating the market, but by whether you've put into place a financial plan and a behavioral discipline that will get you to where you want to go." Again, we want to help people address their financial goal and then make the best decisions to get to that goal reasonably without any risk. And Peter Lynch, he's famous for his Magellan Fund, which beat the market for a very, very long time. He says far more money has been lost by investors trying to anticipate corrections than lost in the actual corrections themselves. The real key to making money in stocks is to not get scared out of them. And my hope today is that now that you understand how a stock works and how a business is valued, that you're going to be less scared to invest. It's not throwing your money in the wind and hoping for the best. You own a real piece of a business that has real employees making real products, and they're trying to grow and put food on the table for themselves. And lastly, I'll close with Warren Buffett, who for most people, this is their favorite teacher when it comes to investing. Heavily encourage you guys to follow him, read his shareholder letters. He has so many amazing quotes, but I'll close with this. He said, "A market downturn doesn't bother us. It's an opportunity to increase our ownership of great companies with great management at good prices. The stock market," and this is my favorite line, "stock market is a device to transfer money from inpatient to the patient. If you can get into owning businesses and hold for the long term, it's going to likely work in your favor. A lot of people can't handle the noise and the headlines, and they sell to the people that are waiting there to get the cheaper shares." So that's my conclusion. A lot of information today. Hopefully that gave you a better framework for what a stock is, and just helping you in your decision making with stock and mutual fund and ETF investing. If you have any questions, you can contact us. You can even scan this QR code to schedule a meeting with me. This will give you a link to my calendar. Happy to answer any specific questions you have for your personal finances. And with that, I will open up the Q&A. So if you want to, you can stick around and type in your own questions. If you are satisfied, you can certainly sign off. This will be sent out as a recording, and the slide deck will be sent as well. So again, I'll hang out and start answering questions that have been submitted. Regarding the slide, how many companies should you own? You said that owning at least 10 mitigates company-specific risk. What type of companies should these 10 or more be? For example, small cap, mid growth, value, etc. So there is not an exact science to what companies you should own. My opinion is you should diversify your industries as well. So I think, if you just own small growth, or you just own like tech companies, or you just own energy companies, you're at risk for that specific sector to go through a down spell. So we would love to see people get not just small companies, but also large, not just tech companies, but also energy, and really spread it out. So hopefully that answers your question. Someone asked, tell me more about PE. If the ratio is closer to 1, wouldn't the price of the stock market closely resemble actual profit? So yes, but anyone that owns a business is not going to sell, most likely, their business for a 1 multiple. Like I use the example of Everhart. If we made $1 million in profit and all the shareholders here sold the business for literally 1 million, which would be a PE multiple of 1, that new buyer, they would make all their money back after 1 year. And it's very likely that Everhart, unless we change something drastic, we're going to at least make $1 million the next year. Ideally, we improve our business model and make even more. So you as the new owner buying at 1 million, you would have made all your money back in a year, and you would have made so much money in the future. We would not want to sell in that scenario. We would sell for a multiple of earnings, maybe 10 times or 15 times. So you'd have to buy us for 10 million bucks or 15 million bucks. That's a more reasonable selling point. So hopefully that makes sense. And then how do you actually buy stock? I'm not sure if you saw the slide on the stock market, but there's different exchanges. The New York Stock Exchange is the most notable, but there's exchanges all over the world. You can go on different platforms, Charles Schwab, Vanguard, TD Ameritrade. There's all sorts of platforms that allow you to buy stock on those exchanges. Okay, someone asked specifically about the Fidelity platform. That would be a good question to reach out to me personally, and I can help you on that. I don't work for Fidelity, so I'm not going to go into their platform. You could also just call them directly and try to get educated on how to navigate their website and buy securities. Next question is, let me read it first. How do you know what the fair value of a company is? For example, is Tesla's worth a valuation of 200 question mark? I think he's referring to my data point that said it has a 200 multiple. Yeah, that's the $1 million question. What is a fair value of a company? That's a really complex the process to go about. I gave you the short way to determine a valuation, which is take its profit and assign a multiple that you think is fair. But there is a much more detailed analysis you could run using a spreadsheet where you forecast every line item that the company has on its financial statement, and then kind of discount the future cash flows, the different profits and expenses back to today's value to determine its price. That's what equity analysts will do at big banks and investment shops. It's really hard to know exactly what the fair value of a company is. Our belief is that the public stock market takes into account everyone's evaluation and how much they're willing to buy and sell, and that gives us the price today. And the price that's listed is likely the most fair price, the actual fair value of the company. So is Tesla worth a 200 multiple valuation? Well, they might be. Everyone's expecting them to grow their profits substantially, and historically they have done that. They've grown like wildfire. So what happens if the PE ratio is negative? Is the company unprofitable? Yeah, essentially, if there's a negative PE ratio, that means you're buying them for less than what they made in profit over the last year, or less than what they will make in the future. So if it is negative, that'd be a very, very cheap situation. If that's actually happening on the public markets, there's probably a reason for it. And people don't want to own that company anymore. So you might not want to own it either. What are the steps to buy my first stocks? I would like to start my stock journey. Is there a site you would recommend for me to open an account with and buy my first stock? Great question. Yeah, and I suppose I should have included a slide on where you can buy stocks yourself. One, you can obviously hire a financial advisor. You could hire Everhart, and we can help you buy stocks. You also can go your own route and buy them on different custodians. So I just listed a few in someone else's question, some reputable names, Charles Schwab, TD Ameritrade, Vanguard, Fidelity. You can go online, create an account, and put money into the account and then buy and sell using their platform. That's an easy way to go about it. And then let's see, I have a 401k from my previous job. I'm not sure if I should leave it or consolidate. Is that something you can help with? Yes, we can help with educating you on your decisions and just interpreting the pros and cons of that decision. So if you're trying to roll over or just consolidate accounts, it's a great time to reach out to us, and we can just kind of give you a holistic picture of what you're working with, and just help you make an educated decision. Do you recommend buying books or just jumping in? Love the question. I'm an advocate for learning. So I would do both. I would learn by practice and learn by just getting knowledge through books. I learned the hard way. My first stock purchase, I lost right away. And it made me question my whole process of why I thought the company was a good purchase. And it totally changed my investment mindset to what it is today, or at least led me on that path. So again, hopefully you had some material to make a better decision than I did at the time. But yeah, investing for the long term is, I think, really valuable to your net worth building and financial goals, but it's a good way to also just learn how to invest well. What percentage of monthly income would you spend on stocks? So the conventional wisdom is to save 10% for your own personal sake, for like general savings and net worth building. So I'm not necessarily saying all of that should go into stocks. There's sort of an order to personal finances where you need a healthy emergency fund. You need to make sure you're paying off high interest debt. And then long-term financial goals, that's where stocks come into play. So I would encourage everybody to have at least 10% of their money going towards building that emergency fund. And once that's built, paying off high interest debt. And once that's knocked out, now you're really going into stocks or other investments if you have different opportunity. But yeah, hopefully that answers your question. Okay, I'm getting a lot of questions. This is great. I will stay on until I guess we're almost at the top of the hour. It's 10:58. So just a few more questions. Do you reinvest your dividends? I personally do. Different platforms give you different tools. Some only allow you to reinvest back into the stock or back into the mutual fund. Others let you sort of take that dividend income and rebalance the account. So they would buy into whatever fund or stock is under allocated to what you want it to be. So like if I wanted 10% in my S&P 500 index and it's at 8% and I got a bunch of dividends come through, it would use that income to actually just buy the S&P 500 index to bring it back to 10% like I want it, rather than going back into the fund where it came from. So there's different ways to go about it. Someone asked about a Roth IRA from insurance company. Would you recommend moving that to either a different company, or could you roll that into my 401k? You can't roll Roth IRAs into 401ks, unfortunately. And whether or not you should roll it into a different place just depends on the investment options you have, what kind of service you're getting from them. There's a lot of lot of data points that go into it. Happy to talk one-on-one. I invest in stocks. Under what circumstances would you sell to reinvest in another? That's depending on your financial goals and your strategy to reach that financial goal. So I can't just give a blanket statement for when exactly you sell a certain fund and reinvest in another. It should all successful investing is acting on a financial plan. So if it's not something that works into your financial plan, I wouldn't get too caught up about selling and buying the next security. That's a little bit like spinning, the hamster wheel, not being very productive. So last question, do you use a standard rebalance equation, typical large mid form percentage? We do have that, and we've shared that in other presentations. In the short, typically around 60% in large cap, about 15 in mid, 15 in small. Across all those categories, we would put about, different advisors have different opinions, maybe 15 to 30% in foreign. We usually have a sleeve of 5% real estate and 5% emerging markets. So, and then it becomes, well, what funds do you actually use inside those categories? And that's kind of what we get paid to do. So won't give away all of our tricks to the trade, but that's a general all stock allocation, but you might not be suitable for an all stock allocation. That allocation you create is really important, and that's what we come in to kind of hold your hand and make sure you're making a right educated choice that meets your financial goals. So love all the questions. Thank you guys for participating. I'm sure I'll see you next time. Take care.